And it's time for our weekly market monitor, who says investors need to be more cautious than at any other time since the financial crisis. And he has names of 2 stocks and an exchange-traded fund that he says could help keep your portfolio safe in this environment. We welcome back Phil Blancato, who's CEO of Ladenburg Thalmann's Asset Management Division. Welcome back. Good to see you.
Thank you for having me back.
At times like this is when investors often, if they're going to buy Treasury securities, want to buy those shorter dated maturities. And you've got an exchange-traded fund who does that for them, right?
Yeah, I mean, we've all made a lot of money in the last 10 years. This year, you're still up 10%. So take some profits, raise your cash levels, or put it in JPSD. It's a JP Morgan product, paying over 2.3% yield with a 2-year duration. That means you get your money back real fast, real high quality income, and it just lets you wait around. In other words, be paid to wait around. That's what you want to do when volatility spikes like this.
You also like Costco. It has a membership fee schedule, and that gives it some recurring revenue, obviously. But you also like it for other things. Why? Key
reason. You think about what we talked about already on the show. Right now, you want to kind of hunker down. And where do you do that? You go focus on the consumer. Why? Consumer is gainfully employed. You mentioned earlier, consumer spending has been pretty robust, and PCE's up a bit, right? So that means the consumer is still active. In that sense, what do they need to buy? Not what they want to buy. What do they need to buy? Costco, at the core of it, where are we going to defend and keep earning money? It's in companies where we're going to need to buy things, and that's Costco.
And the other one's Walmart. You like that one. Is it immune, though, to the tariffs?
This one's a little bit more volatile, but here's what I like about Walmart. They're going through this massive transformation, and I think you can get the company pre the liftoff that's coming. They're the only company that's going to directly compete with Amazon, and they have committed to going to a digital company, and they still got great brand recognition. So you still got that need to go to Walmart. You still got the strong consumer. But at the end, if you can catch this transformation and they get it right, so a bit of a gamble, in the long run, I think you could be paid a nice dividend and get some upside to the stock.
You say next week is going to be critical to the markets because we're going to get some key economic data. We're going to get the jobs report as well. But why do you say that investors need to be as cautious as since 2008? What is it that is that worrisome to you?
The first big worry I have is that can earnings get any better than where they are? Remember, we had last year double-digit earnings growth. This year, they're flat, up 1%. And I'm really concerned that that's going to be the continuation through the rest of this year. So that means for the first time in a long time, we're seeing a real erosion in earnings power. Second, the consumer just may not be strong enough to blast through these tariff issues. They're out there and they're not going away anytime soon. So for that reason, raise some cash, get conservative, wait around, and see how this all plays out.
Right.
Phil Blancato with Ladenburg Thalmann Asset Management. Always good to see you, Phil. Thanks for joining us. And for more on his picks, you can head to our website at nbr.com.